Hello, everyone. My name is Alan Trask. I'm a lawyer at Ward & Smith. I'm a litigator and a general purpose community associations attorney, and excited to be here with you today.
Good morning. I'm Andrew Bateman with Trisure, and I'm an independent commercial insurance agent.
And I'm Amy Wooten, also with Ward & Smith and our community associations practice group.
So we really appreciate you all being here with us today. This is our insurance workshop geared around how to procure the best insurance to match your community's needs, and want to give you a little bit of a roadmap of what we're going to cover today. So we'll go over just kind of building up from the ground. We'll cover the basics of insurance, just some basic concepts, some terms and buzzwords that you need to be familiar with because they inform how to go about securing and obtaining the best insurance for your community. We'll go over the various kinds of insurance coverage that are available for community associations. And we're going to talk about, in going over those, we're going to talk about some special considerations for each kind of coverage that you need to be thinking about as you try to match the insurance to your community needs. And we'll also finish up with some baseline legal requirements. What is the legal floor for what you have to obtain? But we want to contrast that floor with kind of what you have to obtain versus what you should go and try to obtain.
Thanks, Alan. So I'm going to start us off with just a brief discussion on some of the basics for insurance. And when you really think about it, insurance is a way for groups of people to essentially come together and mitigate their risk. And while insurance can, on its face, sound daunting and a little overwhelming, it's helpful to keep in mind that at the end of the day, an insurance policy is just a contract. It is an agreement between an insurance company called an insurer or a carrier in the industry and the person or group of people who are trying to mitigate their risk by buying that contract from the carrier. In the industry, the people buying those policies tend to be called the insured or the policy holder. So it's just helpful to have some of that basic vocabulary down when you're thinking about insurance and those relationships. One of the things that tends to be a common misconception is that insurance is an off-the-shelf product. You either get it or you don't, and you get it as it's sold. But really, insurance is something that you can customize. It's a customizable product, and we'll be talking about that today. And with that understanding, it's important to think about what are the needs that you have when you're purchasing insurance, and is there an option to customize that insurance contract to meet that need?
It can be very important that, as a manager or a board of directors to, of course, know buzzwords. If you don't know these buzzwords, you need to learn what they are. It's very crucial into getting the correct insurance. Like insurer, well, you should be checking in the rating of your insurer. Make sure it's A or higher rated. B or lower, you're in risk of it not being able to pay claims. The insured, look at it this way, it's the Preston in Cary, North Carolina. There are 43 different associations with the word Preston in it. You need to make sure that it is absolutely correct. Make sure that the insured is all the way through Happy Acres Incorporated. Make sure it's absolutely correct. Agent, well, there's an insurance agent, and then your manager is also a legal agent. Make sure you know the difference. An adjuster, you can't have the agent come out and take a look at a claim, or if something happens, the adjuster who is assigned is the only one that can determine coverage, coming on site and investigating what happened and investigating the coverages that are on the policy to make sure that they're covered. Exclusions, you need to know what your exclusions are. Endorsements, are you missing anything or you need to add anything? Coverages, premium, deductible. This is things, deductible is very important for an association. It helps mitigate the risk for claims. As we're going to talk later in this presentation, the importance of, having the cleanest claim history that you can. Deductible is a great way that the board of directors and the manager can help that. But work with your agent to find out different options. Limits. Boy, that's one of the most important things. Make sure that you have the proper limits of coverage. A loss or a claim. Does your policy have a duty to defend? What does indemnity mean? Do you have a program policy? Some HOAs qualify to be in an HOA exclusive program that counts for condominiums, townhomes with property, and HOA with single family. There are programs specifically designed for HOAs, condominiums, and townhomes with property. You better know what all risk means. All risk, it covers everything except for the named exclusions. We just talked about exclusions. Make sure you know what your exclusions are, because when it comes time to claim, make sure that you know. Package first BOP. Well, what the heck is that? Well, a BOP is a business owner's policy. It is designed for small or mid-sized businesses, but it is made also to fit for associations. So a package is a commercial package policy. Well, this is more of a cafeteria style. This is where you can pick and choose your coverages or your endorsements. This is where the biggest mistakes are made, that you think that you have coverages or buy an endorsement, but you don't. So make sure you have all of those and know the definitions of these. If you don't, ask your agent or your attorney.
Absolutely. Just a couple of quick notes on that. Be real thoughtful about the difference between, in the law, there are things like investment products and other sort of very sophisticated things that the customer is not really expected to understand on the same level as the person that is selling that product. Insurance doesn't work that way. Insurance is at its core, like we mentioned before, is just a simple contract. And so it is on you as the customer to understand these things. And, fortunately, you have the resource of your insurance agent and your attorneys and others to help you understand it. But it's really important that you kind of master some of these things. And I'll give you a really quick example. Indemnity is when we're talking about indemnity, we're really talking about the obligation of the carrier to pay some money for some event to mitigate that risk. Contrast that with the duty to defend, which is an obligation for the carrier to provide a legal defense for you in a lawsuit. So just kind of understanding the differences in some of these terms and what they mean is really important. And it is kind of an obligation that the law places on, you as the customer.
And you also want to make sure that you have a good grasp on who the players are. We talked about insurer, we talked about insured, and those words are fairly fixed in terms of who those players are. But one of the terms that you really have to drill down on is agent. There's all kinds of agents. There's your insurance broker agent, who is a good resource for you when you have questions about your policy, about the kinds of coverages you may need. Then there's the insurance agent, who is an employee of the insurance company, who when they make representations about coverage, that's binding on the insurance company. But then a lot of these insurance carriers will also utilize what's called a third-party insurance agency or adjuster. And that agent is not an employee of the insurance company, and statements that they make that pertain to coverage are not binding on your insurance company. And that can be an understandable source of confusion for policyholders. So it's really important to understand what kind of agent you're dealing with to better understand what impact it may have on your insurance claim or your insurance needs.
We're going to be talking about many different types of insurance. Of course, we have the directors and officers, property casualty, general liability, crime and fidelity, and an umbrella policy. These are 5 of the most important There's a few other coverages that we won't get into today, but those are the different kinds of coverages we're going to cover today.
So we're going to kick things off with a discussion on directors and officers insurance. That is a form of insurance that is available to an association to cover claims or losses that are brought against the insurance, or excuse me, against the association itself, or also against the directors and officers of the association for alleged wrongdoing. And that indemnification comes into play when the association suffers a loss as a result of the alleged wrongdoing of the directors and officers, or when it has paid that loss and needs to be indemnified for having made that payment. There are gaps that can come with directors and officers insurance that you want to be out on the lookout for, so that you can go through the process of thinking through customization. Is there a way to contract around these gaps, for example? Some of the gaps that are common in off-the-shelf directors and officers insurance are lack of coverage when the lawsuit doesn't seek monetary damages. For example, maybe the lawsuit just seeks injunctive relief. So you want to look at what the claim is, and you want to think about the potential kinds of claims that could be brought in this space, and make sure that your insurance in this context is as broad as possible. Directors and officers insurance generally does not cover discrimination-based claims, so you want to be thinking about that. You also want to make sure that you are getting directors and officers insurance that covers a failure to procure type of claim. A lot of the standard policies do not provide for that coverage, but it is something that can be contracted for. Breaches of contract. Generally speaking, the insurance company under a D&O policy is not going to have an obligation to provide any sort of indemnity for a breach of contract claim, and whether or not they have a duty to defend will depend on how you contracted for that policy. It's not uncommon for a standard D&O policy to not cover a standard breach of contract claim. One of the things that we see come up a lot in the directors and officers space is having a policy with a limit that is eroded by the amount of money that the insurance company spends defending that claim. That's called a defense erosion or an eroding policy. And significant, what that means by way of example is if you have $1 million limit on your policy and it costs $250,000 to defend a lawsuit brought under that policy, well, on your best day, the most the insurance company is ever going to pay out is that $1 million less that $250,000 that they spent defending the claim. You can contract around that, but you need to look out for and have that discussion with your agent. Spouses, volunteers, and committee members are typically not included in standard D&O coverage. And you also want to be thinking about, should I get an endorsed policy, meaning it's tagged along to other insurance that you have as part of the package, or should I get a standalone package? Our general recommendation is standalone over endorsed for lots of reasons, but it's a conversation that's going to be specific to you and your needs, and one you should have with your agent on what's the best route for you. So.
I just want to interject also in regards to spouses, how important it is to have coverage for spouses. Every policy that if there's a lawsuit against a board member, the board member passes away during that, and the lawsuit transfers to the estate or to the spouse that way, well, there will be coverage. But I'm on a board, I come home, I talk to my wife about something that happened at the board meeting, that we're going to, put a lien and foreclose on Mr. and Mrs. Smith. My wife is out walking the dog and she starts talking, for lack of a better term, but she now is in breach of private confidential information. My wife could be brought into the lawsuit also. specifically for her actions for me divulging this private information as a board member. So you want to make sure that if, because you do vent possibly to your wife or your spouse, significant other, you want to make sure that there is coverage for your spouse also.
And Andrew is so right about that. We see it all the time. And that goes for volunteers, committee members, other folks like that. When lawsuits happen, the way our system works is that you make your claims and your allegations. They don't have to be proven on day one. And so a lot of what we're talking about here with cost of defense, making sure that everybody has the protection of that defense, is because the system works in a way where everyone is brought in, that has a connection to the claim, is brought in typically to begin with. And then as the case evolves, you pair off some of those people and some folks drop out, all that sort of thing. But you want to make real good ensure that your coverage is reaching out and grabbing everybody that's involved. And that's a little bit of what we're going to be talking about throughout this whole presentation, is taking these sort of points for issue spotting and thinking about how that matches up with your particular community so that you can customize the insurance product to best suit the needs for your particular community. One other quick note on non-monetary lawsuits. Look, when Amy and I have both been practicing for about 12 or 13 years, and when we started out, there were very, very few lawsuits between members and associations over things like covenant interpretation or the validity of certain restrictions. Those are non-monetary claims. They are all too common these days, and D&O coverage, if you purchase the right kind, if it's available to you, can reach out and provide protection for that, as opposed to a claim like where they're just seeking damages against a board member for whatever the case may be.
And one last point is, remember, the most basic of things is that if the association does not have the proper insurance, that means the manager and management firm named as the legal agent does not either. So it is most important for all parties involved to make sure that they do have a standalone directors and officers policy.
Absolutely.
Just like I said in regards to Preston about having the correct name, you need to have one address inside the community to make sure that it is the proper association, make sure it's inside the geographical boundaries. The property coverage, of course, is covering just that, whether it's a townhome with property or a condominium, or is it a common element like a clubhouse? But it's also as simple as the entrance sign, mailbox kiosks, fences, and walls. What you have to make sure is what exclusions are there on the policy, what is included, what is not included. Do you have blanket coverage? These are the gaps that are in majority of the policies. Is A, the address is wrong. Gaps is the not having a blanket coverage for all of the property. Water sewer backup, make sure you know what that coverage is. In my career, I have seen just a few handfuls of water sewer backup. Majority of water claims are water incidences. Make sure you know exactly what the water sewer backup is. Make sure you do have coverage for it, but know what that risk is. One of the biggest gaps that we see, of course, is ordinance or law. When we have that, we talked about the package policy, the CP, the commercial package policy. Ordinance or law is an endorsement. It has to be added. You have to make sure that it is on the policy. There are also different levels of coverages. There are 3 different sections to the ordinance or law. You need to make sure you have all 3 sections, and you need to make sure that you know what the limits are for all 3 of the sections. The insured to value report goes right along with, is the property grossly over or underinsured? Where does that number come from for the property insurance? Well, the only guaranteed way to get that exact number is to have an insurance appraisal. The insurance appraisal is done by an engineer. We always recommend you use the same engineer that did your reserve study. They're the most familiar with your property. Have them come back out and do an insurance appraisal, and they will do the per square foot replacement cost. The other way to get that number, ask the actual builder or developer. Thirdly is get an insured to value report, which is an estimation provided by the agent, the insurance agent, of what its core logic is the industry standard, but it is an estimate, but it will provide what the per square foot replacement cost is. From that insured to value report, you're going to be able to get a statement of value. This is probably a term that we should have talked about on our list of glossary of terms. SOV, statement of values. This is where it'll list the address unit numbers, because there may be a number of addresses in the particular building. It'll list the square footage, age it was built, age the roof was replaced, age of when the plumbing and electrical was replaced, and give the building per square foot. This will give the association's total square footage, but from this document, it will help determine whether you're over or under insured with that insured to value report, and also the insurance appraisal. These are some of the things that every community should have as a statement of values, because the board of directors is going to sign it. You are going to be required to sign it and make sure that and attest that it is correct. So take the time to make sure it is correct. If it's not, correct it, change everything by endorsement, and get it correct. On that statement of value, do a quick review to make sure all of the properties and all of the units are listed. If it is not on the property or not on the policy, there will not be coverage for it. That will cause big, big problems.
And that goes back to what we were talking about with insurance policies really just being a contract. If something's not in there, it's not going to be brought in at the time of a claim. It needs to be in there from the get-go. And that's why it's so important to work really closely with your insurance agent, maybe even your attorneys, to get the policy to cover exactly what you want it to cover. Because if it's written down, that, you know, you've got a chance that it's in there. If it's not, it's not. Quick story about how a situation with property casualty became a situation with D&O. Down in Carolina Beach, there was a condominium that unfortunately burned down. It was an arsonist burned it down. And later it became apparent that there was not enough insurance coverage to restore the building to its original state. In the documents, the governing documents, the declaration of condominium, there was a requirement that the board on an annual basis have the property reappraised in connection with the insurance renewal. It's very easy to get into a rhythm of renewing insurance without reappraising the property, revaluing the property. Very important to stay on top of that, because as we've seen certainly in the last 6 to 12 weeks and even longer with wildly fluctuating construction costs and land values here in North Carolina, especially on the coast, you want to stay on top of that. In that situation, because there was not enough insurance money to restore the building, the association then had to levy a special assessment against the members, which then triggered lawsuits against the board of directors and the manager for failing to abide by the requirement and the covenants to get the property reappraised, which triggered a directors and officers liability claim. So that's just an example of how important it is to stay on top of these things, because they can kind of snowball in a pretty complicated way if you don't. So I'm going to cover general liability. This is just your, lots of folks are familiar with this. This is your insurance for, think slip and fall. Someone falls at the pool and gets hurt. A tree falls on a car, hopefully not a person. Those sorts of things, just your general liability events that happen on property. Some things that, you know, to be aware of. Number one, this is not property casualty insurance. This is not to cover a named storm or a weather event or something like that, or leaking water hose. This is to really cover more liability events. These are the risks. They're just like other policies. They're just going to be covered, you know, in the policy themselves. With some things to be looking out for. Medical pay. So since we're talking about sort of injuries to people, you don't want to have low med pay limits. You want to have higher med pay limits so that if there are, you know, medical expenses associated with someone's injury, you got enough money to cover that. You always want to have, and this goes for really as many of these policies as we can get, community managers included as additional insureds. So that if the manager is brought in for whatever reason, that there's additional coverage there. Andrew mentioned earlier having the right property and address on the policy. Well, the name of the association being incorrect on the policy is something that we have actually seen as a cause for denial of a claim. You don't want to have the Preston situation where you've got the wrong name. So just make sure that that is correct. And then, you know, we talk about these low limits. You want to make sure that you have enough insurance because you never really know how these claims on the policy or these claims made against the association are going to be valued. Some of them can be valued in multiple millions of dollars. Lots of folks are familiar with one of John Edwards' cases from the 90s where a little girl got stuck with a pool filter and ended up very, very badly injured and needed a life care plan. Then, you know, from that point forward, multiple millions of dollars. And so you just want to be real thoughtful about that. And we joke about the 4 Ps, the pool, the pond, the playground, and the park. But consider what your common areas are and what limits are appropriate for those things. And again, this is not something that you need to consider in isolation. This is something that you need to consider with your insurance agent, potentially your lawyers too.
On the general liability policy too, just to Alan's point about, you know, this is not for property damage that the association experiences. It's not a property casualty claim, but it can be a little confusing when you look at it and it says it covers bodily injury and property damage. Yes, it does, but it does that for third parties. So general liability coverage is for third party losses. Third party meaning extraneous to the association. It's not a loss that the association has and is seeking to recover for. It's for claims brought against the association for specific losses by third parties. So even though it says property damage and you might think, oh, well, this covers our property, it does not. That falls under your property casualty policy, which is a first party claim situation, meaning that the association has suffered the loss and they're bringing a claim directly against their carrier for that loss. So keeping that in mind and who's making the claim can help you determine which particular policy might be implicated and therefore which duties and obligations may flow from that particular policy.
One of the things that we see the biggest mistakes is in swim teams, excuse me. Swim teams can be either a separate entity where they have their own tax ID and they have their own insurance. Great. You have to treat them with rental agreements when they use the pool for practice and those 3 swim meets that they have at home. If the swim team is under the association and part of the association, we need to make sure that you do have the proper insurance. MedPay most likely will be excluded and you may have to get a separate policy for that. But you want to make sure that the liability is correct because you have so much public at the pool with practices, parents, Plus, you have 3 swim meets that you're going to have at your pool. Huge liability for the association. You just have to make sure you're crossing your T's and dotting your I's.
Yeah, I'm glad you mentioned that, Bob. I'm glad that both of you mentioned those things, because even though general liability is probably one of the more standard coverages out there, it's also one of the kind of groups of claims that can be the highest value and therefore be the scariest when we're thinking about what your exposure is as an association. If you end up with one of these really significant personal injury cases, consider this: an association is one of the most collectible debtors in the world. And the reason is it's just got a corporate bank account, and that corporate bank account has regular, almost guaranteed income. So if a potential plaintiff is able to get a judgment against an association, they're going to be able to send the sheriff out to take that money ahead of several other obligations. And so you don't get to pay to repave your parking lot before you have to pay off that judgment. And so critical, absolutely critical to get good general liability coverage. And there are even, and your insurance agent can speak more specifically to you about this, but there are even instances where general liability can overlap a little bit with some of the other coverages in terms of the duty to defend.
Crime and fidelity. This is the who and the what. Well, who is covered? This is if the operating reserve accounts is, stolen, criminal acts, robbery, burglary, embezzlement, check fraud, wire fraud. These are the things that happen. And the who, you want to make sure you have the broadest definition of who is covered. You want to make sure that you have past, present, future board members, committee members, volunteers, and we're mentioning spouses again. You want to make sure that there's coverage for them. And then the definition of what is covered. You want the broadest definition of what is covered. These are the different types of claims. As the criminals are getting smarter and more creative, you want to make sure that your policy is also covering the check fraud, wire fraud, the cyber liability that is growing. Sometimes cyber is covered here at the crime and fidelity. Sometimes cyber is a standalone policy. Sometimes cyber is covered under the directors and officers. But just make sure that you have the social engineering type of coverage. Social engineering is when you're basically tricked into sending or paying additional dollars. Could be a second invoice. We have had incidences where a pine straw company issued an invoice, said that they couldn't cash a check. The manager went through all of the correct steps, issued a second check, but in the meantime, they deposited the first check and the second check. So they got paid twice for the amount of work. What happens is you let the insurance company, if you have the correct crime and fidelity, they'll pay to reimburse the association, then they'll go after the criminals. Let the insurance company do it. One of the things that is very important is to make sure you're checking your governing documents. There most likely is an insurance requirement in the governing documents. We're not going to get into all of the FHA financial requirements also, but they are increasing and being stricter in regards to the amount of coverage for the reserve and operating accounts. So just be aware of that. Make sure that you have the correct amounts.
This is also another good example of where the types of insurance have some interplay. So for example, in the fidelity and crime world, if you were to have a wire fraud situation, property manager needs to make a wire to meet an association obligation, wire gets intercepted and taken. It is not unreasonable to think that that situation, whether right or wrong, might yield a directors and officers claim for not having the proper tools in place to thwart that kind of activity. So that's just a good example of where you really need to think about the different types of insurance and not assume because you have an insurance policy that it is going to cover all of the potential risk that may spin out of a particular loss.
Yes, and having a professional manager takes away a huge portion of the risk, but the risk is there. It is the risk of the third-party claims or from the board of directors themselves, past, present, and future board members. Just be aware, always. This isn't an expensive policy, but well worth having, no question. I highly recommend.
And the risk is real. I'm sure several of you are aware of some of the embezzlement cases that have gone on over the last decade, both down in the southeastern part of the state, up in the Triangle, with folks that are involved with associations, either from a management perspective or a volunteer perspective, stealing money. It's real, it happens. And it is the most unfortunate thing in the world when an association has several different types of insurance coverage, but not this kind. And an event like that happens and they're left kind of holding the bag. It's just a terribly unfortunate thing, and something that is as avoidable as, and there's an opportunity to mitigate that risk as much in this space as there is in any of the other types of coverages that we're talking about.
Well, this is had the biggest impact in the insurance industry over the last few years. Two of the largest providers of umbrellas for homeowners associations has decided to get out of the industry of providing umbrellas for HOAs. So they've just non-renewed all of them. What is happening is that the insurance industry is hardening. That means that there are not insurance companies lining up to insure HOAs. Not anymore. So it is more difficult to find the correct coverages. Umbrella is one of the largest impact. You're going to see a large increase in premium to umbrellas. The difficulty of underwriting for umbrellas. Coverages are going away from umbrella, and are they follow form or are they excess? Well, a follow form means that if you have the underlying coverages, if you have the correct general liability and the correct directors and officers policy, and you exceed the limits of the underlying, it will go into the umbrella, and the umbrella will be a pool of money to pay those defense or damages. True umbrella will have coverages that you have to have the underlying coverages for the directors and officers and general liability, but a drop-down coverage could be molestation. Molestation is something that we talked about the swim teams. Unfortunately, that awful things happen, but you want to make sure that you've got these coverages. The umbrella truly means that it has drop-down coverages. That will be the primary coverage from the umbrella. We have such high risks in associations. I always mention the 4 Ps. It is one of the most important things: pool, park, playground, pond. Sometimes I repeat one of the Ps. I don't mean to, but it just, they go along. The number one question you should be asking is, does the umbrella cover over the general liability and over the directors and officers policy? This bucket of money in the umbrella, where is it going to respond when needed? You want to make sure that if you can get an umbrella that covers over both, do it. One of the other crazy things that's happening in driving the high cost of umbrellas, nuclear verdicts, for a lack of a better term, where a tragedy happens in an association and the courts are awarding just massive amounts of dollars. It's very difficult to put a value on somebody's life, of course, but tragedies do happen. You want to make sure that you do have an umbrella. One of the most shocking things that I found out recently in the last few months is that there's private equity money. There's $17 billion in a private equity fund that is looking for bad accidents. And then this $17 billion is providing funding for the litigation. And what they're doing it is they're doing it as an investment. And I can't think of anything more disgusting than that. I'm sorry, I shouldn't put my personal opinion in on that, but that is what's driving hardening of the market, umbrellas being more difficult and more costly. There's a few other things that we're going to talk about that's driving.
Well, and it is what Andrew's talking about is particularly acute with umbrella, but is also happening with all different kinds of coverages for associations. And we mentioned earlier that the litigation environment with homeowners associations has just evolved dramatically over the last decade or 10, 15 years. And the evolution of insurance has been racing to keep up. You know, first, when these litigation cases started to pop up and the complexity of homeowners associations kind of went right hand in hand with litigation, the carriers determined that there was a new market. They dove right into it. There was all kinds of new coverages available. Folks were taking advantage of that. But with the increased number of litigation cases in really all spaces, whether you're talking about personal injury, folks, taking it to their association over a covenant that they disagree with or want to overturn, any of that sort of thing is just really having a high impact on the number of claims and pumping up the number of claims. And so we see folks all the time who are struggling with what coverage to get, their claims history, which we're going to talk about. We talked about before, we're talking about now, we're going to talk about again. How to match coverage when you've got a high claims history, how to manage your claims so that you can kind of control that claims history, all that sort of thing. But what Andrew's mentioning about the sort of the hardening of the insurance market, it is absolutely a hardening. It's also kind of a maturing of the insurance market in a sense, and we're learning that that some of these coverages are expensive to obtain. And so it makes what we're talking about today even more important than it was 10 years ago. 10 years ago, 15 years ago, it was what kind of new coverage can I get, to proactively plan. And yes, we're still proactively planning now, but we're also doing it with sort of heightened stakes, if that makes sense.
We've spent a good deal of time this morning talking about what are the different kinds of insurance and are they customizable? What are some of the things that you should be thinking about when going through the framework of looking at customizations that may be available? But we really haven't talked about, of the universe of insurance that's out there, what is an association required by law to carry? So we'll spend just a few minutes talking about that this morning as well. And generally speaking, the law is going to require associations to carry two things: property casualty insurance and general liability insurance on the common areas and elements of the association. The law does not require, and when I say the law, at this point I'm talking about statutory obligations that have been codified by the North Carolina legislature into the North Carolina general statutes. The law does not require that the association carry insurance on individual lots or units, and it does not require that they keep insurance on board members or volunteers or on the individual members themselves. It also does not require that they keep property insurance on property owned by the individual members. Again, common areas and elements is where that is required. That said, that is the floor, right? Property casualty insurance and general liability on common areas and elements is the floor. That is what the association is required by law to carry. But it does not mean that they cannot or should not get insurance above that minimum bare requirement. The law may also require insurance in other settings, in the sense that the law requires associations to honor their contractual obligations. And the declaration is essentially a contract. And it is going to set out insurance requirements that the association may have separate and apart from the statutory obligations that the association may have. So if your declaration says that you will procure directors and officers insurance, then the association has a legal obligation by contract to acquire that insurance. And always the cardinal rule in community association is, what do your governing documents say? So very important to read the statute, but it doesn't stop there. You've got to look at your governing documents too.
And we'll be really quick with this, but we did want to at least establish the floor and explain that. It's a message you've heard before. I know y'all are going to be familiar with this, so we'll move quickly through it, and then we'll clean up with some kind of last additional considerations when you're trying to get the right coverage for your community. But I do want to run through 3 statutes that cover the majority of communities in North Carolina, not quite all, but the majority of communities. The first are 2 statutes that apply to your condominiums depending on when they were created. 47A, Chapter 47A is the Unit Owners Act, the North Carolina Unit Owners Act. That's for your condominiums that were created prior to October 2nd, 1986. And the big theme of that act, if you've dealt with it at all, is that it more or less defers to your governing documents. This is a slight exception in that sort of general deference to the governing documents. It does require the condominium association to obtain insurance for the property, and we're talking about property casualty insurance. But it doesn't tell you sort of like what type within that, what the term of the policy is, the amount of the coverage, who pays for the deductible, any of that sort of thing. So if you are in a 47A condominium, first look at your governing documents, but then make sure that you're working with your insurance agent and your attorneys to get the right coverage, because you're not going to have a whole lot of legal guidance on that. It's a fuzzier floor, so to speak. The North Carolina Condominium Act, which is at Chapter 47C of the general statutes, applies to all those communities, those condominium communities that are created after that date. Very different than the Unit Owners Act. For property insurance, you've got to get 80% of the replacement cost after your deductible of those common elements. You also have to get reasonable amounts of liability insurance, just your general liability insurance. And you know, if you have horizontal boundaries on your community, then it does have to include the units themselves. It has to reach out and grab those units. Your declarations oftentimes require you know that the association carries other insurance, but this is all that the Condominium Act requires. It empowers the board to go get additional coverage, but it only requires property casualty and general liability. And then you know, stepping outside of the condominium space and into the single family and townhome space, we've got Chapter 47F, which is of course the Planned Community Act. That applies in its entirety to planned communities formed after January 1, 1999. Similar to the Condominium Act, and this is where this provision draws from. Common elements, 80% of replacement costs, liability insurance, reasonable amounts. None of these statutes prevent the unit owners from going out and getting their own insurance. So be thinking about how that factors in as well, because that's a strategy that you can work with your insurance agent and attorneys on, is how to best allocate some of the responsibility to the unit owners and some of the responsibility to the association. Maybe you have the association take all the responsibility. It just really depends on your community. But there's some good strategies for how your sort of team can bring that together, whether it's revising your governing documents or kind of going through just a custom purchase situation. You've got some real options there. So those are the 3 statutes that, in terms of the Planned Community Act, that's not going to cover quite every community, but those 3 statutes will capture the majority. And the main takeaway from them is that general liability, property casualty, that's your floor. When we're talking about other things like crime and fidelity, directors and officers, umbrella, that all is exceeding the floor, but it's absolutely something that y'all need to be thinking about when you're going out and trying to get the best insurance coverage to match your community. So these, in our last little bit of time, we wanted to talk about some just sort of catch-all, major, sort of last additional considerations when you're out there shopping, when you're trying to find the right solution for your community. And the three of us are going to kind of bounce around a little bit on these and throw some things out there.
And Alan, just real quick before we get through the list, because it ties back into the statutory provisions. If you have governing documents that do not specifically reference directors and officers insurance, for example, Chapter 55A of the North Carolina General Statutes, which is the Nonprofit Corporation Act and all associations of North Carolina being nonprofits, does have a permissive section that makes expressly clear that an association can procure directors and officers insurance. And if the declaration is silent on that, that doesn't mean that's not available. So it's helpful to keep in mind that Chapter 55A also does speak to insurance in the context of nonprofits.
That's a great point. I'm glad you brought that up. And D&O, if you don't consider any other kind of additional insurance, D&O is a great place to start. Amy, you want to lead us off with the emerging risks and kind of how the market's evolved, and then we'll jump into the rest.
Yeah, absolutely. So as Alan mentioned earlier, you know, when he and I started practicing law 12, 13 years ago, the types of claims that you saw in the community association space are very different than what you see now. And if history is any indicator of the future, that's going to continue to be the case. We continue to see new and different risks come up in the context of community associations. And that's a good reminder for community associations to always be evaluating, not only do I have the right amount of existing coverage, but are there new kinds of coverage that I don't have that maybe I need? We have seen in the last couple of years in particular, an increased need for clients in this space to explore insurance that covers data and privacy related risks. You hear a lot in the news about data breaches. You hear about all kinds of liabilities coming out of that and impacts. So that would be an example of an emerging risk that it would be helpful for an association to think through, am I at risk? Do we need insurance for that? But because risks are always changing, you constantly need to be thinking about, when you're working with your broker, do I have all of the different kinds of insurance? It's really, insurance is unfortunately not a set it and forget it type of thing. It does require constant reevaluation.
You know, one of the, we've spoken about 5 of the insurances. Make sure that we have all of the endorsements that are needed. Watch your exclusions and your gaps. But one thing, we don't have time to talk about it too much today, but it was workers' compensation. Make sure if you do have any volunteers or do any cleanup day that you are at least looking into it and procuring that insurance also.
We talk about, we've mentioned it several times now, sort of your claims history, because that's something that any carrier that is, you know, proposing a policy to you or that you're seeking a policy from, that they're going to want to know, well, how often do you get sued? What is our risk here? How do we value our exposure on this? And what you want to try to do, if you can, is proactively manage your claims before you have a long rap sheet of claims, because what can happen, and we talk about this hardening of the industry, this maturation of the insurance industry, if your claims history is too long, if there are too many claims over the past however, you know, many years, call it 10 years, 15 claims in 10 years on a D&O policy, you are going to have a very, very difficult time finding good insurance that's affordable. You might be able to find it, but it may be cost prohibitive. And so this is one area where your insurance agent, having a close relationship with your insurance agent and having an attorney, it sounds salesman-y, and I don't mean for it to, but having someone that is really familiar with your community that can help you in the moment decide, do we file a claim? What is our real exposure here? And I'll give you an example of where communities run wrong. You have a $5,000 deductible on a property casualty claim. There's $7,500 worth of damage on a water leak. There is no reason in that situation, just painting broadly here, to file a claim. You need to be looking at internal solutions at that point. And the reason is the benefit is not worth that claim going on your sheet. Think about it when you wreck your car. Say you back into a telephone pole by accident. You know, we've all been there. It happens. You often, when you're talking to your insurance agent, you've got to think about, what is my actual repair bill here? And is it worth it to me to file this claim? Because it's going to have an impact not only on your premiums moving forward, and Andrew can speak to this a little bit more, but more importantly, on your ability to go get real coverage in the future. And it's not that you should not file claims. Look, insurance is there for a reason. But you want to be thoughtful about what the value of the claim is before you file. What are you getting back in exchange for putting that on your sheet? And in that, you got to think about your community, how litigious it is, what are the issues that y'all are dealing with. All of that sort of thing kind of goes into that bucket, and that is where your professionals can add a ton of value. And I would plead with you to be proactive about how you file the claims, and not just flippantly file claims, because some things you need to take on for yourself. Now, if you are dealing with a situation where you already have a significant claims history, we all on this call and others that are in the advisory space can help you with some strategies, both for self-insurance, seeking sort of novel products, all that sort of thing. It's beyond the scope of what we're really dealing with today, but I do want you to understand that if you cannot, go get traditional products, there are some more advanced strategies for mitigating your risk that we can help you with.
You know, keeping affordable insurance, it's hard work, no question. Over the next 12 to 24 months, you're going to see a clean, loss-run community have a 10% increase. Associations with claims, you're going to see 30% or higher increase in premiums. The more preventive maintenance that you can do, water detection devices, communicating with the unit owners on what they can do on their side to protect the future of the community. As Alan spoke, your loss runs, your accidents are 5 years on your loss runs. So just be aware of that.
And that really ties in. Oh, I'm sorry, Amy, go ahead.
No, I was just going to say, and don't think that just because you might have switched carriers that information's not available to the new carrier. The powers that be in the insurance world know. They're all seeing, they know if you've had a claim within the past 5 years, even if it was someone else. So just be mindful of that when you're thinking about what the future may look like for that claims history.
And that ties all into, what are your funds for insurance? And this needs to be a major part of your budget every year. It probably already is, but these cost increases, you need to know about them. You need to be having proactive conversations with your insurance agent about what is going on out there in the market before budget season. What you don't want to get caught in is a situation where you have a renewal in the middle of the year, say 6 months after your ratified budget or your approved budget, and you don't have the money to go get that, and then you got to deal with special assessments and all that sort of thing. You want to be way ahead of the game. So early and often is the rule for these sorts of discussions, because as Andrew mentioned, the market is in flux. And it's rapidly changing, and it's really important that you sort of highlight this issue as something that you need to be paying attention to. We're going to be real quick with the last 3 bullets. I'll take the first one. Andrew will take the underwriting, and then we'll have a quick note on regulated versus unregulated carriers. We have a bullet up here for what's the real versus the imagined risk. What I would say here is you need insurance. We're not saying don't get insurance and that all risk is imagined or something like that. But what we do see all the time are people that sort of allocate their resources in these various coverage buckets in a slightly incorrect way. So for instance, they may overweight their general liability and underweight their directors and officers. And that's going to be different for every single community. But we have seen communities where, for instance, there is a ton of general liability coverage and the only common element is a cul-de-sac and a street. And there's very little directors and officers coverage, but there are all kinds of weird decisions that the board has to make about stormwater issues. So in that situation, you want to think about accurately valuing your general liability coverage and making sure that you've got enough D&O coverage. Just a quick example.
With the underwriting issues, we could have a whole other presentation in regards to that, but the three things that I'm going to talk about is roofs, electrical, and plumbing. The insurance companies are going to be much more selective. Much more selective means higher premiums and less choices, less coverages. Roofs over 20 years, an insurance company can deny you just for that. Once you get past 30 years for electrical and plumbing, you're going to see difficulties. You need to start planning now for these future expenditures. You're going to have to face them. So look at them now. It's less expensive to look at them now than in the future.
And just a very quick note on regulated versus unregulated carriers. They're really sort of two general buckets of carriers. Those that are regulated by the Department of Insurance in the state of North Carolina. I guess one way to think about it is approved carriers. It doesn't mean that other carriers can't provide coverage to customers in North Carolina. It just means that there's a different set of regulations that apply to them. Sure, we all want to seek out coverage from regulated carriers. It's a safer place to be. It can get more difficult to find regulated carriers that will pick up the coverage if you have significant claims. And in the property casualty world, I mean, all communities on the East Coast have hurricane claims at this point. And so several of those communities are having to go to unregulated carriers, international carriers and others that can step in and provide coverage. That's fine. There's nothing inherently wrong with that. But if you find yourself in a situation where you have to go out of market, where you have to go to the unregulated space, you just want to treat those policies with a little higher level of scrutiny, and your agent and your attorney, I know I sound like a broken record, can help you with that. But you want to be doing that as a part of buying that coverage, really, really scrutinizing the policy to make sure that it covers what you want it to, because you don't have as much regulatory protection as you would if you were working with an approved regulated carrier. All right, well, we have come to the end of our presentation. Appreciate everybody's patience with us, and I think we'll be in a situation where we can take some questions from the group.